So thanks for coming. Thanks for having us in for part of your education. My name's Richard. This is Derek and Glenn. We're from FBC, Farm Business Consultants. We are tax experts in multiple industries, one of which is real estate. So we know your industry quite well. We've got all the tricks of the trade to be able to put or keep as much money in your pockets as possible. Meeting with real estate agents, a lot of people think, well, my taxes are pretty simple. I've got basic deductions, and I've got my car and meals, and that's about it. That's utilizing a very small part of tax law. We utilize a lot more tax law. So if you think your tax return is pretty simple, that's the old system. We're here to just kind of open up your eyes a little bit more to how much money you can actually keep in your pocket and not pay to the CRA. Because if you're not utilizing all of tax law, then you're overpaying in your taxes and you're losing money. And I'm sure every single one of you would like to keep more money in your pocket than pay it to the CRA, right? Taxes are bad enough as it is. We all need to pay taxes. They're very important, obviously. We've got education, we've got our roads, we've got healthcare. Really important that we pay taxes, but we should only be paying what we actually owe, right? We don't want to have to overpay. I don't want to overpay by a penny, personally, and I'm sure you guys are all kind of the same situation. Yes, we owe taxes, but I don't want to have to pay an extra penny. Well, chances are majority of you in this room are overpaying. So we want to be able to help fix that. So a little bit about who we are. We're a national company with over 65 years, small business tax knowledge. So we started back in '52. We're called Farm Business Consultants because we started with farmers. Back in '52, the government decided to start taxing farmers. It was a whole new world. Our founders understood the tax law and understood farming. Hence, the business was started and it grew from there. They became the best friends to everybody in the neighborhood, as I'm sure you can understand, and it grew from there. 5 years after that, we got into small business, and we've been growing since. We're the only firm in Canada with a year-round membership. So one of the things you're going to find out about taxes is it matters what line your deductions are going on. It changes your taxes drastically. So with a year-round membership, one of the first things that we're going to point out is with accounting services, it's a professional service, and it's not completely deductible for all of you. But a membership is 100% deductible. So one of the first things we do is our fee is 100% deductible. Kind of nice, right? Tax technology leader in optimizing tax returns. So when we do your tax return, we look at it a little bit differently. We'll probably put together about 30 different returns for each of you, based on your plan, the strategy that we put together for you, based on where you are. Do you need to, as a self-employed business person, are you looking to get a mortgage? Are you looking to buy a car? The ideal tax situation is you bring your net down to absolute minimum, so you pay the least amount of taxes. But that means you might not qualify for loans. So we may have to stage or step up your income, make sure that you qualify for those loans. And then as soon as you get that loan, drop your net right back down so you're paying the least amount of taxes again. But that takes a plan, takes a strategy to be able to do. That's something that we do. So which of those 30 tax returns is right is dependent on what your individual situation is. We submit that and we go from there. Providing at home or place of business. So we come to you. You don't bring your taxes to us. We either come and meet you here at the office, at your home office. We do it in front of you to make sure that all questions are answered. We don't want to leave with unanswered questions. That's the worst. You drop off your books to a regular accountant, and a week later you get an email. Well, we don't understand this, or we're missing that, and it goes back and forth. No matter how it's done at that point, possibly things are getting missed. You don't want to miss anything because that's more money out of your pocket. So we do it right in front of you to make sure if we have a question, if something's unanswered, we get the answers right then and there. Maybe you forgot a receipt. We've been at different farms and they forgot that, they put $20,000 down on a new tractor that's sitting in the driveway, and the receipt's somewhere else. Well, where's that receipt? Because that's kind of important. So we're looking for stuff like that, making sure that we catch everything and we're on the same page. Team of over 300 highly trained and motivated FBC staff focused on one goal: to make your life less taxing. So there's a lot of us. If the individual rep that you're working with doesn't know, something's come up, something is odd with your situation that they can't answer, they can pull from a lot of other people to make sure they get the answer. They don't make it up or skim by it. They find the answer for you. Okay? We've got nearly 20,000 small business owners that we're working with currently. So we're not a small company, being around for quite a while. In 2016, I think that number is from, we proudly saved our members over 27 million in taxes. That's a lot of money. I'd like to see that kind of money personally, but we're also one of the only companies in Canada that actually guarantees our tax returns. So the regular accounting system, you get your books, your papers, your deductions, your receipts, you hand it to the accountant after your year end, and they put together a tax return. A couple weeks later, you go by, you sign off on it saying, great. They hand you that folder. It tells you how much you owe them and how much you owe the government. There's also a liability in that. The first paragraph, this is based on the information you provided. What it's meaning is, if they're wrong or they screwed up, it's your fault, not theirs. They're not liable for what they do. We don't have that. So we are liable for our tax returns. So what that means is, if we send in a tax return saying you owe $7,000 in taxes, and the government comes back, the CRA comes back and says, you know what, FBC, you've made errors, your calculation's wrong, and can prove it, we pay that difference. We guarantee your tax returns, and that's in writing. So if you get audited, this is one of the things that we're going to be talking about today. What leads to an audit and what do you do during an audit? If you get audited, all of our clients, they're covered. So there's different steps to an audit. There's what we call a bench audit. It's probably all of you have gone through that. It's a simple conversation, quick call, where you get that brown envelope in the mail saying, we didn't understand that, or because you're declaring this, we need just proof. Give a receipt. Sometimes you get a little bit deeper and they'll ask for the top 3 deductions or top 10 deductions. They just want to see actual receipts for that. So that's the basics. A lot of people go through that. Then it gets into a field audit. That's the painful one. They show up at your house or your office and they don't leave for a week. They go through everything. You really don't want that. But either way, we're there. We show up with them. We actually answer all the questions, and it's covered in our membership. You don't pay by the hour. You've already paid. So everything that we're doing is included. If they come back and say, you know what, we don't agree with what you've done and can't prove it and keep pushing, we'll take them to court. Legal fees, court costs, lawyer fees, fines, penalties, whatever it takes, we're covering it. It's included in our membership because it's us backing and supporting what we've done for you, right? That's part of that guarantee. So getting into the top tips. So hopefully some of you guys will take notes on these. Always file a tax return and file on time.
You're not able to share that with them.
Yeah, we can.
You know?
But sometimes if you're writing it down, it goes in better. So this is one of the big points for you guys. A lot of the real estate agents we work with are behind a year before we start working with them anyways. They're behind a year, even if it's filed, sometimes they haven't actually paid the taxes for a little bit because your industry is a little finicky. It's up and down. Sometimes you'll get a really big paycheck and then you won't get paid for another 3 months, 4 months. So it's up and down and it's hard to figure out exactly budgeting. So when your taxes are due, sometimes you don't have that sitting there and you get behind. Well, you need to file it on time. That's one of the main things that we're pushing. And well, as a company, we keep you on schedule and on time with that. How many people keep a mileage log? Anybody?
I have an app.
You have the app. Okay, this is one of the most important things you guys need to take from this. If you can't prove your mileage, you'll lose all your expenses for your vehicle. So your fuel, your insurance, your car payments, that adds up quite a bit, right?
Yep.
If you get audited, you lose them. You need to be able to prove your mileage. A lot of people look at vehicle expense, well, my fuel. Okay, I drive X number of kilometers and I've got a $40 gas receipt, so I'm gonna claim the HST and there's some deductions in there, I'm sure. But the government actually allows for 54 cents a kilometer, including your fuel, your payments, your insurance, everything. That adds up to a hell of a lot more than just your gas. I know one of my trips I live up near Collingwood, so I drove from Collingwood to Guelph, went up to Barrie, had to go to Coldwater, and then back to Collingwood. And it was about 750, almost 800 kilometers by the time I was done. It only cost me about 30 bucks in gas. Okay, my vehicle's pretty good on gas, but it was just under $300 in deductibles. That's a whole different world. You're losing a lot of money if you're not doing it properly. So we sit down individually and figure out what's the best way to calculate that for you and show you actually how to do it, because you're losing a lot of money if you're not actually tracking your mileage. There is an app that we recommend. It's one that we've partnered with. It's called Mile Catcher. Yeah. So it's awesome. As soon as you start moving, it's GPS. It turns on in the background. If you've got more than one card, it'll ask you, well, what card did you leave it today? Well, this one. Okay, great. When you park, after a couple minutes, it pops back up. Was this personal or business? Swipe left, swipe right, and you're done. It's pretty simple. Yeah. Yeah. And then it also spits out a monthly report. So we know exactly what's going on, and that's your mileage. So if you've got 3 different stops in your day, you can actually even do it at the end of the day. Well, that one was personal, that one was business, and that one was business, and you're done. It's so easy. It only takes a second, and then you don't have to worry about mileage. It tracks your A to your B, which is what they need, how much is in between it. It even shows you what the total deductible on that trip was, and it adds it up, and you can total for the month. You can look at just money just going back into your pocket. Okay, this I'm actually gonna get Derek talking about, and that's keeping your business and your personal finances separate, because it's really important.
So this more so pertains when you're getting into using either lines of credits, credit cards, stuff like that to help yourself through the business for doing showings, advertising, anything you need to do. The issue you have with credit cards and lines of credit, if you're running personal through there, the government can come back and say none of that interest is deductible for yourself. Or none of those charges for bank charges or fee charges are deductible if you're running personal through the same account. So it's always better to keep those separate. If myself, I have one card that I use strictly for work. That's all I use, my gas, anything I'm out, that's what I use. Then I have my other card for family, whatever else I need. If I went to mingle them, the government can look at it, and if they can find one personal thing through there, they can actually come back, disallow all interest, disallow all fees, anything like that to do with that card. So you don't want to lose out on it, because sometimes it can be pretty big depending on what you're doing.
So you want to be able to try to separate that the best you can. Again, we understand the world that you guys are in. And sometimes you do have to blend your credit line a little bit because groceries are kind of important. But if you do have to, make sure you itemize it, separate it out, make it very visible. We'll show you how to do that to make sure that you've itemized it properly so that we can make sure that the CRA is not upset when they look at that.
Well, the good thing by doing that, you can then, if you have it itemized, you can allocate a percent at that time. But that's when you have it itemized, what's personal and what's business.
Any questions on that? Okay. So making a mortgage interest tax deductible, I think you wanted to expand on that one too.
That one as well is essentially, if you're looking for, sometimes it's hard to get, you have to do some showings, you want to do, get some advertising out there, and you might not have the funds on yourself right now, but if you have equity, you can actually turn a small mortgage for your house into your line of credit, essentially. So you can actually go and borrow based on your equity, and that whole amount, if you're using it strictly for your business, the interest is fully deductible for yourself. But on the personal note, same thing, if you use an equity loan and you use investments, then it's fully deductible as well because you're investing for yourself during the future as well. So that's another side note for the personal side.
Yeah, this is one of the ones that people find really interesting. How many people take clients out for dinner? Kind of best practices, right? Every once in a while, at least. When you take them out, you probably use your credit card, debit card, you pay for it, and it's 50-50 deductible, because that's meals and entertainment. We'll go back to the fact that it matters what line you're putting stuff on, right? Depending on what your deductions are. So one of the things we'll teach you, one of the tricks that we give out, because we have a lot that we give out to our members, but we give out little tidbits to you guys just as general because it saves you money. So gifts to clients. Instead of taking somebody out and using your credit card, you go and you buy a prepaid Visa or prepaid MasterCard. You write their name on the back of that receipt. Then you take them out for dinner with that credit card. It's now promotional. You're promoting your business because it's a gift to the client. It's now 100% deductible. The dinner receipt, throw it away. Don't double up your receipts because it's no longer valid. In essence, what you're doing is you're buying a $100, $200, depending on how big the client is, I guess. If you're going to Swiss Chalet or if you're going to Ruth's, $100 gift card. In essence, what you're doing is you're giving them that as a gift, as promotional. $100 gift cards going to them. That's what the CRA is concerned about. So their name goes on the back of that receipt. By utilizing that gift card or that Visa card now, doesn't matter what it's used for. So you use that to buy them dinner. It's 100% deductible. Okay, now don't go crazy with this and do not buy a bunch of gift cards to take yourself and your family out and try to claim it. That's going over the line. We won't support or back that. It's got to be taking out clients, coworkers, stuff along those lines, and it's got to be valid to what your income is. You know, if you're netting down at 80,000, you've got 60,000 in promotional, they're going to have problems with that, the CRA. Okay, so it's got to be relative to what you're making. And again, individually, we will go through that with you and say, well, what's reasonable for what your income is to be able to maximize on that.
Another thing on that is if you are giving gifts to your clients after the fact, after a sale happens, make sure what you're giving them. If it's something that can be classified as either entertainment or meals, the government will come back and say it's a 50% deduction. So if you actually give them an LCBO card, or if you give them
A cake card.
or Swiss Chalet, something like that, they can say that is pertaining strictly for a meal that they can go for. Whereas a Visa or Master, they could go to Home Depot and buy something they need for the house or Canadian Tire, something like that, right? At that point, it's not up to you to worry about that because you gave what you did, right? But if you give them a specific item, then they can come back and say, nope, that's entertainment, that's meals, 50% deduction.
Does that make sense? Okay, renting out a portion of your home. Again, Derek on this one.
This one I've actually changed. Renting out the home is more so if you're going to be renting out your home, make sure that you're not depreciating your home. Make sure you're not doing more than 50% of your home, that type of thing, because then you turn your house into a business. You lose the principal residence deduction at that time.
So if you invest, $40,000 into the basement to build another apartment down there to rent out as business income, don't depreciate it. It's an expense. It's gonna, you want to depreciate it because there's some money sitting there short term. You get a little bit of money back. But long term, if you lose your resident status on that and you have to pay capital gains, that's gonna hit you a lot harder in the future. Okay, this one's kind of fun. So how many people donate to charities, churches, and they get those receipts, charitable receipts? Okay, you don't actually want that. The first 200, I think it's 15 or 16% deductible. Over 200, it's what, 26% deductible? 29?
Yeah.
A regular receipt, 100% deductible. So the example is, yes, giving to your church or giving to a charitable. As business owners, this is the change, as business owners, you can't deduct more than the 29%. But if you say maybe you're supporting the local hockey team or baseball team, you get your name on the back. Chances are they're not registered, they give you a receipt. That's now promotional, 100% deductible. So if you've got the option, you don't want the charitable receipt. A lot of people, oh, I need a charitable receipt. Well, if you're getting a T4, then that's the only deduction you can really get. But as business owners, there's a lot more deductions you can get. So you actually want the regular tax receipt. And this is one that we're going to get into. The laws are changing. The opportunity for you to be able to incorporate is coming closer. We've been watching it for the last 4.5 years now, almost 5 years. It's past second reading, and we think the only thing that's really holding it up right now is there's an election in the spring. Now, incorporating, though, is not right for all of you. Incorporating, it changes your structure, but it may just mean you're paying a lot more money. Because a lot of people look at incorporating, well, corporate taxes are much lower. But the setup for a corporation, when you're in the lower end of the money spectrum, it's set up so that, yes, you pay lower in corporate tax, but you're still paying yourself in salary for taxes that way. It's meant to be about the same as a corporate owner as being self-employed. Until you're getting into a lot more money, then your dividends, salary, there's a lot of other things that you can do. But until you're making really good money, and we'll tell you where that line is, it doesn't make sense to incorporate. So with all of our clients, we're sitting down with them individually when the time comes to let them know the positives, the negatives. Does it make sense for you personally? And if it does, we'll do it for you. We'll do the incorporating documents, we'll do your minute books, we'll do everything for you to get set up. Teach you what the difference or the change is, what you have to do now as a shareholder, not as just a business owner, and then move forward with you that way. But if it doesn't make sense, we're going to tell you shouldn't. Again, we're business consultants. We're not running your business. If you want to incorporate because you want to, we're not going to stop you. It's your business. We're just going to tell you you're just going to lose money. So getting into the favorite part, paperwork. How many people do their own books? How many people do books? There's now minimum standards with the CRA with your bookkeeping. So the shoebox of receipts doesn't work anymore. You can get actually fined up to $1,000 a year from the CRA if you're not organized properly. So we want to make sure you've got minimum standards. What that means is you've organized your receipts. Maybe you've done a subtotal. It's on a spreadsheet. So yes, I've got 80 different receipts, but the total for that is $5,000. You want the minimum standards because the CRA, if they do an audit, they don't care how many receipts you have. They don't care the individual receipts. They want to know the total. And they want you to be able to prove it. They want to just quick. They don't want to spend a lot of time. They're understaffed. They don't want to spend a lot of time on your audit. They want it quick, simple, and if you can't provide that, they'll charge you. So almost a third of all businesses have been audited in the last 3 years. That's huge. You guys are targeted, and so are farmers, because you guys do a fair bit of things wrong. Like the number of people with a mileage log in this room. The government knows that. They know the industries that are not doing things properly, and then you become a target. What does that mean? Well, $100 million invested in audits resulted in $8.3 billion. How would you like to have that return on investment? Do you think the government's going to keep doing it? So that goes into hiring new auditors. They're in fact, they've got auditors now going through your Facebook accounts, your Twitter accounts. They're trying to catch you however they can. They're not evil people. I try to tell people that anyways. They're not evil people, they're doing their job. And if you're trying to get away with something, they're getting better at catching you. That's what it's coming down to. If you're doing everything properly, there's nothing for them to find. But they're spending the money. So we want to make sure that you're doing everything right and accurate. Because there's the right way and the wrong way, right? So audit tips, comply with tax rules and regulations. That's kind of self-explanatory. Don't be fraudulent, don't lie. You want to pay the least amount of taxes, but do it properly. Knowing how the CRA selects taxpayers. People don't realize this. Computer-generated lists. You guys buy lists, some of you anyways. There's different organizations that will send you lists of people that are looking to buy homes. I was talking to one gentleman, he pays, I think $2,500 a month, but it related it to $160,000 for the year. That's a pretty good list. So the government does the same thing. Audit projects, you guys are an audit project. They understand that you guys aren't doing your taxes properly. You're missing stuff. You're claiming stuff you shouldn't be. The mileage log, we keep going back to that one. But that means that you're an audit project, so they're spending money specifically on you guys. Leads. So you deal with somebody that doesn't like you, there can be an anonymous tip to the CRA. I think they're doing cash deals. You're being audited. Pretty simple. Secondary files. So this is an interesting one. You guys will partner up with builders, you'll partner up with other people to make sure homes are put together. So anyone that you're doing business with, chances are your name's connected. The CRA follows the money. So if you're being audited, they're going to look at everybody you're working with, everyone you're doing business with, and they might be audited because of it. CRA is not going to say, well, we're auditing John, so therefore, you're being audited too. No, they'll just call and we need supporting documentation on this, this, or this. They're following the money. It's like a spider web. So think about who you do business with. Are they above board? Because you could be audited just because they are. So what causes an audit? We're going to go through a couple of the quick triggers. So back to that first one, not filing your taxes on time. That will trigger an audit every single time. They also might close your bank account. I don't know if any of you have gone through that. That's a painful process for people as well. It's a scary thing when your bank account suddenly closes and they empty it for you. Filing a return with errors. Now, when you go to your accountant, you sign off on that liability form they prepared for you, chances are there are some errors because everyone's human, especially at tax time. Accountants, they're doing a lot of work. That's their main part of the year, and they're working 18 to 20 hours a day. So do you think some of the numbers kind of blend? We've gone in and, numbers are on the wrong lines, the numbers are reversed. It happens. You're liable for it, and if it gets filed, it could cause an audit. You don't even know that there's an error there. But the rules state, you're signing off on it, you're saying it's right. So in essence, you're supposed to go through that tax return page by page and make sure everything's correct. Well, if you could do that, you wouldn't be hiring an accountant to do it. You're kind of trusting in their expertise, right? So dealing with who you're dealing with, that's business. You got to make sure you're dealing with the right person, making sure that they're not making those errors. With our company, if Derek's entering the information, again, he's only human. He can make mistakes, but it goes to our head office and they look at it. We guarantee our tax returns. Do you think we make errors? We don't want to have to pay for them. So we've got more eyes looking at them before it gets submitted to the CRA. Kind of important. Not providing information when requested. How many people have gotten that little brown envelope and they're like, and they just put it aside and they maybe don't even open it. Others, we were actually at a client's 2 weeks ago, and he just handed a stack of these beautiful brown envelopes from the CRA completely unopened. And he's like, I'm too scared to open them. Well, it could be a simple thing. It could be that they just needed a receipt. They've got a simple question. Because you didn't answer that, now you're into a full audit. It could be a 2-minute conversation, and now it's going to be a painful week. Answer the letters. You don't want to give anything extra though. Don't be nice about it. Just give them what they need. They ask for this, that's what you give them, nothing else. Don't try to be nice and say, well, I'm submitting this and it's because of this or this or this. And you're trying to make it easier for their job. Don't, please, please, please don't. Because now you'll be audited for a different reason. Because they're like, oh, we didn't even understand that, but now we do, and now we're going to go after this and this and this. Just, if they ask for something, give that item, okay? If they want more, they'll ask for more. In fact, with our members, we ask that you not answer anything at all. If they call you, my representation is FBC, do you want their phone number? They already have it, they know we're on your account. We answer those questions for you. Claiming consistent loss. Now, this doesn't affect you guys as much, but if you're always in the red year after year after year, the government's going to wonder, well, how are you financing your business? How are you eating? How big is your bank account? Because a business can only finance itself by the owner for a certain amount of time before you run out of money. They're going to want to know where that money's coming from. Are you accepting cash deals? So that being said, there's also times when there's an explanation, like a business starting up. You're putting a lot of capital into it, like farmers, for example. There's millions of dollars of equipment that they need to buy. Well, you depreciate it and you slowly get back into the black. But that's a story we can tell, so the government understands that. If you're just a real estate agent, you're always taking a loss every year, well, why are you a real estate agent? How are you financing it? What are you trading? High expenses against limited income. We touched on that before. If your income is at 80,000 and your promotional is at 60,000, you're gonna get audited, guaranteed. They're gonna wonder why, how come you're spending that much money on promotional? Are you really investing that much into building your business? Because if you are, you're spending way too much time trying to build and you're not actually making money. So we'll set up an audit because they'll want to know. And again, this is something we actually go through with you to make sure that you're not over doing your expenses based on your income. Now this one you can't do anything about, but it does automatically set up audits. Welcome to the world of being a real estate agent. One year you make 200, the next year you make 140, then you make 300, now you make 80. It's dependent on the industry, right? The market. Now, if the market's hot and you're just not going to work, well, shame on you. But if the market's hot, you're gonna make more money that year. The next year it might not be hot, and you drop quite a bit. Well, that sets up an audit because they're wondering, well, your income's fluctuating all over the place, what's going on? Well, they're real estate agents. Oh, well, yeah, that kind of makes sense, but it still sets up an audit. Any questions? Please.
About tip 6, the second from the last, high expenses against limited income. So in our industry, generally speaking, what kind of percentage of expenses say being considered as reasonable?
Well, it's not so much as a
I mean, generally
percentage.
speaking, say if I make 100,000, so if what percentage? Say 300,000, 200,000, 30%, 20%.
There's not a specific percentage. It's based on where you are in your business. They're going to be looking at that. If you want to expand on that.
Yeah, like if you're making $100,000 each year, if they're looking at, say, advertising, for example, promotional gifts, that type of thing. They're also going to look at, and they will look at it, is your commission on each individual invoice that you get as well. So if you get commission on a sale that you get $5,000 worth, but you're spending $4,000 back as a gift, they're going to question that right away. But if you do get commission of $5,000, you do $500, not too bad, or $600 or a little bit more. So it's proportional to what you're getting, right? So not on a whole as a year, it's proportional to what you're receiving throughout your deals as to what the expenses pertain to. So that's just with advertising and promotional in that though. If you're looking at, if it's for your vehicles, that type of thing, then it comes down to your mileage log. If your mileage log proves everything, you're fine. You got the high expenses of vehicle, you're traveling a lot, you're fine. That proves it. So it comes down to the different items that you're looking at for expenses.
And that's why it's not a cookie cut. We as a company look at the regular accounting system as kind of flawed. Now the reason I say that is you go through your year, you're doing what you can, you make decisions about your business, good, bad, or ugly, you're making decisions. You get to your year end, you get your books, you take them to the accountant, and they do what they can to present a tax return. Try to save you as much money as they can, but numbers are numbers, math is math. They're not magical creatures. They're not going to magically change. So there's only a certain limited number of things that an accountant can do after the fact. We as a company, we work proactively with our clients. So before the end of the year, we want to make sure you've done absolutely everything to reduce your taxes before your year end. So we start by planning. Well, what's your year look like? What are you planning on doing next year, the next 5 years? Is there a succession plan involved? You know, are you looking to buy a home? Investment properties? Is there something that you're doing in the near future that we should know about because it changes what your taxes are going to look like? Then we build that strategy. Well, what can you deduct? What can't you deduct? We provide software if you don't currently have it for free. We teach you how to use it, to actually do your books and keep up with them. And it's awesome. It automatically pulls all your expenses in. You just have to say, yeah, I was at Staples. I wasn't buying toilet paper. I was buying office expenses. So classify that. Okay, it's really simple. Once that plan and that strategy is built, we actually do consulting year round. We'll do outbound phone calls. Has your plan changed? Has anything happened? Yep.
Does your membership include spouses?
Yep.
Our tax, like all these tax planning?
Yep.
Yep, that's why the membership based on everyone individually. That's why we can't give a set number as to what it is, because each spouse could be completely different. We don't know what they have.
Yeah, when it comes down to pricing, we have to sit down with individual people to say exactly what that is, and I'll get into that in a second. But once that strategy is built, you've got the consulting year round. If Derek's your rep, you could call him daily. You could call him late at night. I know I do.
Twins will get you in trouble.
Yeah, but they're there to answer questions. You know, if you've got a concern, my car broke down, it's gonna be $3,000 to fix it, it's the transmission, it's getting a little older. Is it better that I invest back into that? Should I buy, should I lease, new, used? Well, individual to where you are financially in your business, we can give advice on what's the best option for you and your business. Because it changes depending on what you're doing. Now, those are decisions, like that's specifically a decision you make, and typically you Google it, you talk to friends, you know, you ask who you can, but you make a decision pretty quick. And it's based on your current knowledge or information. Give us a call. We'll tell you as business consultants how it affects you and how it affects your taxes, more importantly, at the end of the year. Because depending on what you can do can change your taxes drastically. Okay? So after the consulting, a lot of our members get what's called an ETC, an early tax call. This is really special. So you've got December 31st year end. So from January to about beginning of November, we come out, we actually do your tax return up to date. We'll sit you down and say, okay, as of currently, you owe $13,000 in taxes. Here's a checklist. Do this, 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 and this before December 31st. And we can get your taxes from 13 down to 7. But you have to actually do the list. It gives you two things that two pieces of information. First off, you now know 100% you've done absolutely everything over the course of the year to reduce your taxes. How many times have you left the accountant thinking, I could have done things better, I'm paying more than I thought I should have, could I have done things differently? Well, with that, you know 100% you've done everything, down to the penny. And also, as self-employed business people, it gives you a 5-month window of actually coming up with that $7,000. Okay, because you know approximately what your taxes are going to be. Okay, well, math is pretty simple at that point. I've got 5 months, I owe $7,000. This is how much is going into the checking account. And then when you actually owe it, write the check and get it off your plate. It's done. Then you don't have to worry about interest charges and fines and penalties, and those things will double your taxes real damn quick. You've got it, be done with it. Okay? Then the next thing in our membership is actually doing your tax return. Okay, and as I said, we'll do about 30 of them for each member of the family. Your spouse is included, right? Is there income splitting? Is there something that we can do from a taxation to maximize so everybody pays the least amount of taxes? Okay, and again, that's part of that strategy, individual. Once the tax return is actually filed, then the audit protection. We actually guarantee to back up and support what we do. If you get audited, we're there. And it's included. You don't have to pay extra. Yeah.
What's your annual charge?
As we mentioned, it's based on individual. So it breaks into two different parts. So the first part is business structure. So you guys are sole proprietors. There's also partnerships and corporations. So that changes the level or the baseline of what our membership costs. So you're at the lowest one. Yay. Then it's based on gross revenue. How much money do you make? Because the more money you make, the more we're going to charge you. The less money you make, the less we charge you. Now the reason for that, go back to that 100% guaranteed tax return. There's liabilities. So a $50,000 tax return, very, very different than somebody making $5 million, right? If we screw up a $5 million return, it's going to cost us. So we charge them more. Does that make sense? Now that being said, the difference between somebody making 100,000 and making 200,000 could be $100. It's not a big difference, but it's that liability that's attached to it. And that's why we sit down and actually go individually, because that's kind of private information, you know, what your investments are, what you're actually making as individuals, what your spouses are making. We sit down privately and go through that. We have a fancy calculator that individually figures out exactly what your membership fee is, if you want to come with us. Then you pay up front. Right now, we're doing the 2018 tax return memberships, which means you're paying now, and it includes your 2018 tax return. So you'd be paid up until April 2019. Most of you haven't done your 17 yet. We do that as a prior. Okay, because we don't have all the extra, the planning, consulting. It's already finished, your year's done, there's nothing we can really do. So we're just submitting your tax return at that point.
How do you base your 2018 membership on money that has not been earned yet?
On your 2017 tax return, or your 2016 tax return, whatever's the last filed tax return, we're taking information from that.
So it
Okay.
fluctuates every year.
Yes,
just
every
like
year.
your income fluctuates.
Yep.
Yeah.
Because when we're actually sitting down with you in April or is it February, March of 2019, when we're actually sitting at your dinner table and we've got all the information there, we're actually putting together and accumulating your tax documents. We're ready to submit. Okay, well, last year you made this amount. This is what we're submitting. This is what you would owe for 2019 tax year. How is the service? Do you see value in what we've brought to the table? Would you like to resign for next year? Okay. If you didn't see value, don't resign. You've paid up to your tax return. We're all good. If you didn't see the value in it, go back to the old system.
Can you give us an average, like for example, based upon $100,000, how much membership fee would that be?
I can't because there's so many different variables in it, but what I can say is for sole proprietor, starts at about $800 and goes up to some of our bigger memberships, 45,000. They're making millions. But chances are for you guys, if you're around the 100 ballpark, probably around $1,200. But again, we'd sit down individually to go through that. You could be the 8. But think about what you're actually getting for the service. We're working hard for you guys. We're putting more money back in your pocket. Is that of value to you? Or do you just want a tax return? Because if you just want a tax return, we're not the company to work with. If you want a partner to work with you in your business, to help you put more money in your pocket, we're also a business community. Well, what are some of the 1%ers doing that maybe you're not doing? Is there business practices that we could bring over? Suggestions. Again, we're business consultants. We're not running your business for you. But if they're making millions and you're not, well, what are they doing differently? Could we help in any way? It's not necessarily part of FBC. It's us individually. Because we've got clients that are in the industry, right? We know their business intimately. We're going to know your business intimately. Maybe you're making some mistakes. We can patch. Does that make sense? Anything to add? That's about it for us.